year was a little challenging for all of us. But one of the good things that came out of it is that knowing that no matter what's going on in the world, we can still communicate, we can still educate, we can still make sure that we are informing our clients and our prospective clients and our guests. And that's extremely important to me, as everybody knows. You know, we speak English here. I get asked all the time, and it was asked to me in Dallas and in a meeting just yesterday. Victoria, like, how did you build this company and all? And I said, well, it was from the foundation. The foundation came from people. And it was actually older women in particular saying that they were not heard, that they didn't know if they made money or not. When they went to a meeting, they didn't understand the language somebody was talking. Okay, the men were talking because they would speak in a language they didn't know. They're talking about beta something and alpha something and standard deviation something. And I said, well, this is my promise to you all, that we're going to speak English. You're going to get reports you can understand. And when you have questions, we welcome that. And if for any time, any reason that, you know, you come in and I know the look, somebody glazes over, Jan. They glaze over, I stop and I go, what was it? What was it? And in one case, I'll never forget this woman. She's the sweetest, most lovely woman. And she had that look. And I had just used the word yield. And she was embarrassed because they came from somewhere else. They'd only been clients a couple of years. And it embarrassed her to have to say, I don't understand exactly what that means. But when I stopped her and I said, you just got that glazed look, ask the question. So for us, asking a question is so important to us because we know all this stuff. You know, we know it. So we want to make sure. So any question that you choose to ask today, there's no stupid questions. And if they are, Stacy's going to take care of you and she'll clean it up for you.
That's right.
So see there, we got you protected all the way around.
Speaking of questions, we have a question for you. Okay, so we're going to launch our very first poll question.
Yes.
All right, so here's the question. I'm going to read it off to you first.
Can do it as well.
I'm going to read this to you first, and then you're going to see the question pop up on your screen. So which of these activities that you couldn't do in 2020 because of we know why, have you enjoyed most in 2021? So I'm going to launch this poll question, and you should see that pop up on your screen. We're going to leave that up for about a minute and give you an opportunity to answer that question. So from our audience here, what's one of these activities or some activity?
The old-fashioned way. We'll raise your hands by the raise of hands.
Yeah, who?
What are the questions? The questions are.
Oh, okay.
I know you can't read them.
Sorry.
The questions are that you've enjoyed that you didn't get to do in 2021. That really means something to you. So is it travel, family gatherings, going out, dinners, movies, anything like that, or attending sporting events? Let's travel.
Travel. We got to vote for travel.
Travel.
Just going somewhere.
Just going
get out of my house.
Yeah.
Going to Lowe's.
Yeah.
Going to Lowe's.
Woohoo, we're going to Lowe's.
Chuck, you need to get out more. That wasn't one of the options.
Yeah, because they were not on the option list.
That's
We're
right.
gonna count them as going out. Chuck, just for
That's
you.
right.
Chinese buffet.
Chinese.
There you go.
I missed the lunch.
There you go.
Yeah.
Excellent.
Movies.
Yeah.
Yeah,
So
that was-
we all know that last year was, well, it was just the pits. And I think all
That's a
of us.
very kind way, actually, of saying it, wouldn't you say?
Well, we are broadcasting live.
Oh, is this
This
being
is the
recorded?
PG-13 version.
And this
of
is being
even-
recorded?
It is being recorded.
Okay,
that's
then,
right.
yes, good job.
The R-rated version will be next week, okay? So anyway, we know that last year was tough. In many ways, this year's been tough too, but there's a lot to like about what's going on. So let's go ahead. I'm going to end the poll now. Thank you so much. Oh, wait, no, a few of you are still responding, so we want to give you a chance to
Give
respond.
everybody, well, and I already gonna tell you, I mean, look at this up here. Chuck, you win. It's just going out. It's like getting out.
Yeah.
Getting out of my house, getting out of my office. People were really tired of, I mean, I'm still meeting with people that are working from home. My neighbor across the street, I'm just Jasco. I mean, he's still working from home. And you just think how long that has gone on. And then I was in Dallas meeting with a woman from Fort Worth, and she's still working from home. She says, Victoria, I need help. She goes, I need the synergy. I cannot do this anymore. And I said, I can help you with that. I started calling all my friends with office space. I haven't lived in Fort Worth in 40 years. And she's lived there. I was like, I'll find you an office, honey, because it is tough, you know, officing from home. especially for that length of
Well,
time.
let's go ahead and share our poll results here. So you
Let's do
should
it.
see that come up on your screen.
Chuck says I won.
That looks like 30% of you are excited about travel. That's something that you're done. By far, the biggest winner was
Going to
family
Lowe's.
gatherings.
Oh, really? I thought
Family
it was going
gatherings,
up.
44% said
Wow.
being able to go to family gatherings.
That's nice.
Many of you are probably going to gather for Christmas and Thanksgiving. Maybe you didn't get to do that last year. Or travel. I'm going to Disney World for Christmas.
He is.
Yeah. So
He's more excited than his two boys. I'm just telling you right now.
Yeah.
The boys are like, okay, this is cool, but dad's like over the top.
There you go. There
And
you
that's
go.
all true. Wait till they get there.
You know, the first time I ever ate escargot was at Epcot.
Really?
Yeah, it tasted like dirt. Slimy dirt. Going out to dinner, movies, parties, 15% and 11% said attending sporting events. Interestingly enough, the Thunder season starts tonight.
Mhm.
And I remember where I was last year, the night that they were playing the Jazz. And interestingly enough,
Yes.
guess who they're playing tonight? The
Jazz.
Jazz. All right, and that's when the world changed.
Yeah.
Was the night that the Thunder played the Jazz.
Oh,
So I wonder what's going to happen tonight.
all is good. All is good.
All right. Well, thank you very much for participating in our poll there. Let's move on here. There we go. So again, as you know, last October, the first Diva and Friends event we did was last October. Here's what we were
Yeah.
dealing with
What was
at that
going on
time.
then, Damon? Refresh our memories.
Well, there was
It
an
seems
ice
like a long
storm.
time
There
ago.
was an ice storm the day that we hosted our first Diva and Friends event. And literally 30 minutes before we went live, we lost electricity. And luckily it came back, the internet came back, but you know what?
God loves me,
We were-
is all
we
I
were-
can say.
That's right. COVID-19 was ravaging our nation. We couldn't attend a show, movie, or sporting event. We couldn't travel. We were preparing for an election. All of these things, yet, but here's the crazy thing, the market had significantly recovered since its low point in April and May of that year.
And
over the
because
next few
because
months.
of COVID, nobody knew what that meant
Mhm.
because we hadn't experienced that before. So that was the big issue. The market's like, oh, I don't know what's going on. And it is due to the fact that the market is what? It's about our confidence.
Yeah. The market measures what we believe the future is going to hold. The economy measures what happened in the past. So now, here we are in the present, and since last October, so there was all that bad stuff, but the market was doing great. Well, now, most of the lockdowns have ended. Our economy's rocking.
Again.
We can get out and see each other again.
Mhm.
We can go to family gatherings again. That's what most of you were excited about. COVID-19 cases are generally declining. There are spots where it's still pretty bad. Domestic travel has returned, still can't really travel internationally yet. However, it's kind of a reversal. Now the market is dealing with a
Confused.
bunch of uncertainty. Yeah, that's a good way to describe it. It's confused.
Market is confused.
You've got all of these different pressures pushing up and down, and the market is
Kind
searching.
of like Oklahoma weather. When you think
Yeah.
about it, the pressure up and down,
That's
that
true.
causes a tornado.
That's exactly. I didn't know we were going to talk meteorology today. I would have
Well, hey.
prepared. So anyway, so it's kind of a reversal. Our world has opened up, but the market has kind of gone haywire, at least since April and May. The first quarter of the year, the market was up a little over 11%. Since then, it's been kind of flat, up in maybe 3 or 4%
Mhm.
in that
But
time.
we still, and we say we, all the projections are that we're still going to end in a decent place this year. But then there are, as we all know, naysayers out there, or people that, panic. And if everybody panics, that's what we get, just like what happened in 2008.
Yeah.
I mean, people panicked, rightly so, except for here, nobody panicked, which was no, we were panicked. But the fact that we didn't make any changes was our saving grace, which was a really, really big deal. This happened also, wasn't it at the end of 2019 when Charles Payne came and he talked about, I saw him get very emotional. And Charles Payne, those of you that do not know him, has a business show on Fox Business and Making Money with Charles Payne. And he was here in Oklahoma speaking to the Men's Dinner Club. And he got really emotional. I want to say it was in February, and he asked me to be his special guest. And he got emotional about the fact that the media really he said just right there. It was almost, and it was the media causing a lot of panic. And when the media does that, people react. And when you react, it only hurts the consumer. And I'm telling you, you got this big old 300 and something pound big man, his voice is cracking, and I'm sitting there going, I want to go up and give him a hug. It was very emotional. So that really stuck with me that night about what he was saying and the control the media has. That really, it was about hurting Americans and hurting investors.
Yeah.
So we don't want that. Nobody needs to, no panicking here.
It's usually not a good idea to sit at home and watch the news all day.
Yeah, really, turn the TV
It's
off.
just not a good idea.
No.
It's garbage in, garbage out. However, there is uncertainty. There's
Right.
volatility. Well, what's causing it? Well, we've got rising inflation.
And
Certainly, prices are much higher this year than they were last year.
And we don't have to tell anybody that.
That's right.
Everybody knows it. All you have to do is fill up your car. All you have to do is go buy local bread. Oh, my husband was having a meltdown over chicken prices just last night. He's tripping. Nope, we're not buying any more chicken. Now it's going to be ground beef. I go, ground beef is less than,
And so, a lot of the inflation we're dealing with right now is low supply, high demand.
right.
We don't have enough products, so supply of products, but there's also a shortage of labor. We can't even get the ships off the Long Beach Pier unloaded.
So I'm saying.
And
they're
even
sitting
if
out
they
there.
get unloaded,
We don't have the truckers.
That's
We're
right.
down
That's right.
68,000 truckers in this country. And then there's the California, I can't remember what they're calling it, but there's California's being blamed for all this regulation for truckers. And they're doing interviews with truckers like, we're not going to California. And go, no, we really need you to go.
Yeah.
Because you see all those ships out there, they have our stuff on it. And we really want our stuff. So would you mind just get a few of your friends and go pick it up?
Yeah.
No, but that is a huge, huge concern. And that's why we're hearing all of this about, we've all been hearing it, about Christmas. Do you believe that or do you not? Well, just watch the news for a moment, just a moment, and look at all those ships. We were out there and I'm, taking pictures of all of these ships. And I thought we were like being attacked or something. It was like, you couldn't believe how many ships were there. And it's like, no, they're just sitting out there burning oil, just
a lot of their
waiting,
crews have
trying
left
to
the
get,
ships.
trying to get in to the ports, and it's just not happening.
So we've got supply and labor shortages, continued government spending. Many of you have questions about what impact
Yeah.
will the government continuing to spend money that we don't have.
Okay, what did I talk about this morning? I was guest speaking at a women's event, and I said, this is about the government prints money. When people say they make money, I just like, oof, we don't make money. No, government, we just print money. That's making money. No, we earn money in exchange for our talents, our skills, our services, our relationships. This is an exchange here. So we really earn it. But it is a huge concern about this huge tax bill that's coming. I mean,
Yeah.
it was bad enough that we all kind of went, oh, well, it's COVID. Go ahead and pass it. We kind of need that $3 trillion. And now they're like, okay, we did it before. Let's do it again. No, it's probably not such a good idea.
No, it's and that's why they're looking at raising taxes. So you can expect next year. That's probably when we're going to hear more about tax legislation. There are many proposals.
We'll be back telling you about
We're
how
gonna
good
be-
it's going to be on your taxes
That's
next
right,
year.
on the cutting edge of keeping you updated on what's going on with tax legislation. Nothing has made it to the president's desk right
Thank
now.
goodness.
In fact, most of it is still in committee.
And I like that tax deferral term. For those of you that knows what that means, it means like, I want to defer those taxes as long as possible. So as far as I'm concerned, he can just let it sit on his desk. Defer the taxes as long as
Well, why
possible.
don't you call it?
Okay.
Okay.
I'll do that, Damon. Just
So you see some of these other issues that are causing all the uncertainty in the market. The reality is this, I mentioned it at the top of the show. The stock market is basically driven by how we feel, all right? The economy, when you hear the economic numbers, that is reporting what has already happened in the past. The market is like a magic 8-ball. It is trying to predict what we think is going to happen in the future. That's how we invest. If you believe a certain stock is going to go up in the future, what do? You go out and buy it now, right? To enjoy the run up. So that's what the market is trying to determine right now. Which direction are we going to go? We got people that are very optimistic. We got people that are pessimistic. Those forces are pushing against one another. And that's why you see the big ups and the big downs. But since April, it's largely been flat. And that's exactly what we were predicting at the beginning of the year. A good start of the first quarter, but a flat second and third quarter. Now, we were actually predicting that the fourth quarter would be positive. What we weren't sure about was the rise of the Delta variant of COVID, and that's kind of
things
squashed a
that you
little bit.
cannot predict. That's why in our office, I always say, we control the controllables. You cannot control what goes on out there in crazy land. You cannot control inflation. You cannot control what the government does. You cannot control COVIDs or pandemics. What you can control is making wise decisions on how much cash do I have? How much do I have in protected assets? How much do I have in stocks, bonds, and mutual funds for 30 years down the road? How much do I have in oil and gas revenue coming in, so that when I do retire, I have these different funnels of money? And that is, one of the main reasons that, like I said, the world panicked, but I used to always, and I say this on the radio all the time, the radio show out there, I'm talking about those people out there, not our people, because, those things did not happen. And that's why you recover when there are events like this that you cannot control. If you plan properly before, then you're going to come out of it much more quickly and much safer than those that, panic. And it breaks my heart when somebody comes in, this, Damon, and did panic and went to cash, and then they come in and like, Victoria, please fix this for us,
Yeah.
So we don't do that. No panicking at this time. Control the controllables.
We do have another poll question for you. So we like to make this interactive. Which of these factors concerns you most at this time? So that's the question. I'm going to launch the poll question right now. So your choices are, as you see on the screen, and for those in our audience, which of these factors concerns you most? Taxes rising, inflation, increased government spending, or the lingering impacts of COVID? There may be other things that are
Yeah, like all your stuff sitting out in the ocean on trucks, and the fact that you wanted to buy a new car and you go over to Lexus and they have 3. I was there yesterday. It was not pretty. I was just very sad. But the question is that, what is it that the factors that concern you the most? So let's go through those. These are the top questions in the country. I still think the things floating out on the ocean are pretty important to me, because when I want to buy something I can't, it makes Pamela cry because she loves to shop. And when she can't get it, she's like, Victoria, it's going to take 6 months to get you these new pair of shoes. I'm like, that's okay, I can wait. I got other pair. But it's taxes. So just think about these 4 things: taxes, inflation, the increase in government spending, or the impacts of COVID continuing. So let's start with who thinks taxes is the most important concern to them right now. Okay, how about inflation?
Okay, a lot of votes for inflation.
Does not surprise me. Increased government spending. There we go.
You can choose
Oh,
more than
yeah.
one.
I was
That's
like,
right, yeah.
Jen says, I want D, all of the above. All of the above.
All of the above, right.
And who's most concerned about lingering impacts of COVID?
Okay.
Yeah.
Yep.
Say,
Well, that's very close to what we have here online. So I'm going to go ahead and end the poll here. It looks like we've got most everybody has responded. So I'm going to share the results. As you can see there on your screen, 11% of you, your biggest concern is taxes rising. We've got 39%. Second place, inflation. That was a big one here among our studio audience. Increased government spending was number 1 online, 43%. And that was also a concern here among some of our studio guests. And 7%, the lingering impacts of COVID. So clearly on the minds of people right now, at least among our company here, inflation and continued government spending and what impact that might have on the market.
Damon, what this does, when we appreciate very much that y'all participate in our polls, because there's so much noise out there, that when you share with us that those are the 2 top concerns for you, that helps us narrow down our time. Damon and I spend so much time on webinars, being at events, I'm going to the field advisory board that I'm on. We will be asking these questions, and those are top of mind to me now. When you say that's my biggest concern, that's what we're going to focus on.
Yep. So we're going to have Jordan coming up here in just a few moments. And we're really looking forward to hearing what he has to say. That'll be your opportunity to ask some questions. I see that we've already had some questions come in. We're going to save those questions for Jordan when he comes on. We don't want to steal.
Unless you want to know where Damon got his new pretty suit, or like he's so snazzy. A little plug for Maggie. She dresses him now. I don't have to do that job. Maggie takes care of
If
it.
you're
Look how
looking
snazzy.
for a custom clothier, Maggie Chipman Davis with Tom James Clothing.
Yeah.
But that's what we.
Yeah, you should open. He has his own closet here now, just so y'all know. He has his own closet here at ChappelWood.
Are
I
there,
don't have a closet, but he has a closet.
so, are there any thoughts from our studio, guests today or our audience today? Any questions or things that you would like to add?
Could you tell me briefly about what our guest speaker or guest is background's like?
Well, yes, we will do that. And we're going to give you, we're going to introduce him in just a moment. And so, but we will tell you, I don't want to spoil the bio.
Okay.
But he is with JP Morgan Asset Management. He's the vice president with them. He works primarily on the bond side of things, but he is very well versed in other aspects of the market. And so we're excited to hear what he has to say, but we'll give you more of a background on him.
And I'm sure that, knowing Chuck the way I do, I'm sure that he has some questions. Have you already submitted some
I
questions?
did not. I do have some.
You shocked
Well-
me. You're gonna make me look bad because that surprises me more than I can tell you. And he goes,
That's
Victoria,
quite all right.
why would I submit them when I'm right here? I'm a live audience participant. I can just speak right up.
I figured you needed a live question.
There you go.
Well,
Okay.
we are going to ask that question because we are very happy to, oh, wait, there is
Oh,
one.
more thing.
You know what? This is one of my favorite slides.
It is
And
his favorite
and,
slide. I let him put it in.
no, you can see-
Always puts it in.
you can see Jordan has joined us. There he is. Hey, Jordan, how's it going? We're going to get to you here in just a little bit. But this slide right here is actually from a piece that Jordan works on. It's called The Guide to the Markets. It's produced by JP Morgan, who is one of our investment strategists here at ChappelWood.
And we get that every single month. And we
Mhm.
really rely on that
Yeah,
to help when clients ask questions. We can go back and not just, this is our opinion. We can go back and pull facts from this. And it's a wonderful piece that they've been doing for years.
yeah.
Dr. Kelly, excuse me,
Yep.
David Kelly is my go-to man for anything that I have a question on. You have all these people. He is the first guy that I go to. He
Yeah.
was so helpful to us all during the crisis and the financial crisis. And that's when I got to get to know him really well. And I've met him several times at different live events, but
Yeah.
He highly recommends Jordan.
Of course he does. That's why we have Jordan on today. See there, Jordan, we're trying to get you a raise right now. Okay, that's what we're trying to
Our
do.
compensation, he goes, just get me more business, Victoria. That's
That's
all I
right.
care about.
But what you're looking at here is a slide that shows the S&P 500 over a 41-year period from 1980 to 2021, or so far through 2021. And when you hear about uncertainty and you see what's going on in the market, you see it's going up and down, that sort of thing, it helps to remind yourself why you are invested. Now, if you're day trading, you're taking advantage of major movements or even small movements in the market, that's fine. But that's not what we're doing here, okay? That's not the point of what we're doing here, ChappelWood Financial, or any of our clients. We're not day trading. We're investing for the long term. And when you look at this, what you see is that 31 out of 41 years, the S&P 500 has been positive, all right? There have been 10 years when it was either negative or zero, flat. But the interesting thing, so the first thing to remind yourself is that for the most part, the market goes up. Its tendency is to go up, sometimes small amounts, sometimes a lot. But what I think is really interesting, Victoria, is look at those red numbers down below. Those red numbers indicate, and Jordan, you can correct me if I'm wrong on this or if I'm misstating it, but those red numbers represent the low point that the market hit that given year. Is that right, Jordan? Or is that the number of dips that we saw?
It's the largest intra-year decline in the given calendar year.
That's right. So for example,
The biggest drawdown that we've seen in a given calendar year, that's what that red dot.
so yeah, in 2021, we've already seen a 5% drawdown, earlier in the year. In 2020, the market ended up in positive territory, but at one point, there was a 34% decline. We know when that happened.
That's when I talk about panicking.
Mhm.
That's what the other people do. We don't do that. Those are the other people out there. Your neighbors, your friends, your family. We don't do that here.
That's right. So without further ado, let's go ahead and introduce our special guest because it is 4:00.
Perfect
And we want to
timing.
give Jordan plenty of time. So this is Jordan Jackson. Now, Jordan, you can't speak until I formally announce you here, okay? In his role with JP Morgan Asset Management, Jordan Jackson is a vice president responsible for delivering timely market and economic insights to clients across the United States. He recently got married. He and his wife, you guys live in DC, right?
That's correct.
But today you're in Arizona.
Yes.
He's appeared on CNBC. He's been on Market Watch. He's authored several papers on the economy and the markets with a focus on bonds and the Federal Reserve. So that's where Jordan spends a lot of his time. And one of the responsibilities that he has is compiling much of the data that goes into that guide to the markets that we were just mentioning a moment ago. So that is one of our go-to resources, something we use all the time. And with that, Jordan, welcome. Thanks for joining us.
Thank you for being here. We appreciate it so much.
Thank you. Thank you so much for having me. I'm very, very excited to be joining this group here this afternoon. So thank you for having me.
Well, Stacy, can you hear us?
I sure can.
All right. Well, Stacy is our moderator today. And so I know that we had a list of questions that came in ahead of time. So Jordan.
But does
So-
Jordan,
Yes.
Jordan, I want to give Jordan an opportunity, if I could, Damon. Did you have some opening remarks?
Oh,
before
yeah,
Before we go into questions, do you have something prepared that you would like to share? That, I know I like, when I go in and guest speak, there's some really important things that I want to share, and then I open it for questions. So whatever you're most comfortable with, because we have people and they have questions. So whatever
Sure.
you're most comfortable with.
Absolutely, absolutely. I think where I would like to start is potentially on the debt ceiling. Obviously, that's very topical, and we've more recently got a short-term extension on the debt limit. So as of October 12th, the House approved measures to increase the debt ceiling by $480 billion to the new debt limit of $28.9 trillion. A lot of money out there, a lot of borrowing that we've been doing, especially more recently. But I do think this does help to ease some of the concerns that markets were having around a potential default or that we might not be able to pay for the government's obligations. So I do think that does provide a bit of a short-term relief. But at the end of the day, it does just kick the can down the road. And at some point, we are going to have a more permanent fix as it relates to the debt ceiling in order to push forward a lot of the spending initiatives that are currently being discussed. But more broadly, I think for us as investors, the landscape that we're currently provided with is generally speaking a constructive one. I think it's one that we can be optimistic about and one that we are confident in terms of positioning. We're positioning overweight towards equities relative to bonds. We think earnings are the primary driver, continue to be the primary driver of stock market returns and performance over the next 12 to 18 months. We do think that we are going to get some degree of additional fiscal spending as a result of sort of a reconciliation package. So I think that could help stoke markets as well. But I do think that this doesn't come without some degree of volatility. And Damon did a great job sort of setting up that volatility slide. We've gone a long period of time without that average market correction of around 14%. So far, year to date, we've only seen a max drawdown of 5%. So we may be in for a little bit of volatility, a little bit of choppiness. There's a lot of concerns around things around China. There's obviously concerns around how COVID will develop in the months ahead. And so we always think that there should be portfolio should be well diversified for that risk, because we don't know when the next market correction is coming or what might cause the next market correction. But generally speaking, where there's more things that we can check the box and be sort of optimistic about in terms of market returns going forward than we are pessimistic about. And I'm sure there are a bunch of questions that'll tie into that outlook. So.
All right. Well, we do have some questions. So Stacy, hit us with our first question for Jordan.
Okay, you have quite a few questions coming your way. So are you ready?
Let's do it.
Okay.
I'm in the hot seat.
From Rick, what are the stock market implications concerning the proposed Biden tax increases?
Wonderful question. So in terms of the increases that are currently being proposed, now remember, these are tax increases tied to the spending package, which is currently projected to be at about $3.5 trillion. Now, this process, this additional spending is supposed to come through a process called reconciliation. Now, what that simply means is that the overall level of debt cannot change as a result of this additional spending. And so it needs to be met with some degree of revenue increases in order to offset this increase in spending. So what's currently being talked about, obviously, on the spending side are additional tax benefits, extension of the child tax credit, a host of different, universal pre-K, additional money towards healthcare entities, and a bunch of other things. But what's also being associated from the revenue side, while some of these spending measures are estimated to provide some growth, economic growth to help pay for it itself, there are some tax increases that are associated, namely increasing the top marginal tax rate from 37% to 39.6%. Also a 3% surtax on those incomes over $5 million. Also in terms of capital gains, potentially increasing the capital gains tax rate from 20% up to 25%. There's also talk about increasing the corporate tax rate. So increasing the corporate tax rate from 20% up to 26.5%, as well as increasing foreign incomes. So that's going to take a hit on a lot of those tech companies that have operations overseas or in international markets, taxing foreign income, increasing that rate from 10% up to 16.5%. I think for investors, probably the tax increase that we're probably most concerned about are obviously the tax increase on the top marginal income tax bracket, but also those in the capital gains as investors. The good thing is we've seen this story play out before. We've seen capital gains tax increases in 86. We've seen first in 76, 86, and also in 2013, you saw capital gains tax increases. Now, over the 6 months leading up into those tax increases, you tend to see a little bit of wobble in equity markets. Equity markets on average sold off anywhere between 5 to 10% ahead of those capital gains tax hikes. But thereafter, you tend to see very, very strong performance on average markets rising between 10 to 15% after those capital gains tax hikes were put into place. And I think the key there is that it's not so much about the changes in tax legislation, but more so about the fundamental drivers of the equity market, the current macroeconomic environment. And it was very robust environments back then, along with those capital gains tax increases, right? Generally speaking, we want to increase taxes when the economy is doing very well. That's generally what tends to happen. And so you saw markets perform very strongly after you saw those capital gains increases. I would also mention that any sort of increase in the capital gains tax rate would be done retroactively, meaning that they won't come out and say, well, we're going to increase capital gains on January 1st, 2022, right? That would suggest that maybe investors might try to get ahead of paying a higher capial gains tax rate.
That happened in China. That actually happened in China. I remember the day it happened, I was getting phone calls and from TV stations, Jordan, to come over and do interviews. And I was like, I'm sitting around going, what happened? They want me to talk about what? It only took me a couple of minutes to find out that's exactly what happened. And everybody was selling it because of just the discussion of it. And that's what makes sense. Why wouldn't you? If you knew that they were going to put a capital gains tax on your investments, that's what people did. And that was the only reason. It didn't even go into effect. It was just the fear of that. So it could be very, very volatile.
And Jordan, is it true? And again, I've seen both of this. Are they looking at increasing this capital gains rate for everybody or just for people in the top income tax bracket?
Just people, folks in the top income tax bracket. So obviously for those folks who the top income, top earners, top wealth, own a lot of the taxes, or a lot of the stocks, a lot of mutual funds outright, and so this would be a direct impact to them. So again, they would apply retroactively to the date of the announcement to avoid some of that forced selling ahead of when that capital gains increase will be put into place. But generally speaking, as I mentioned in some of my opening comments, you still have a very supportive backdrop for equity markets and more broadly for stocks more broadly. And again, I think the primary driver is going to be earnings. How are earnings? What are companies actually bringing in through the door by way of consumer consumption? How we're going out and spending back into the economy, and it does a lot of what we're looking at suggests that earnings are going to perform very, very well as we move into the fourth quarter into 2022. And I do think that provides enough support for stock market performance, even if we do get some sort of capital gains increase.
Thank you.
All right. Are you ready for your next question?
I am ready.
Okay. All right. So this is from Jennifer. And Jennifer says, what should the layman, non-financial industry people look for when it comes to global markets? Are there certain events or other triggers that should prompt us to know there will be a reaction in foreign markets?
Well, yes, I think there's a few things. That's a
Great question, by the way. I'm just saying, let's applaud you. That is a really good question.
I think there are a few things that we can really look towards. The first, I think, is honestly similar to how we look towards here, things like inflation. How is inflation performing? Because that very closely ties into the type of reactions that we're going to see from central banks. Now, we know that central banks have been in concert, creating money, pumping money into the economy more broadly. And that money tends to find its way into investments. Some of it finds its way into bonds. Some of it finds its way into equities. But when we look at sort of the trade-off between bonds versus equities, we generally find that equities provide more upside potential today than bonds. And so when we talk about sort of this TINA trade, there is no alternative. We think that money continues to sort of make its way into equities versus bonds. And I think this is on a global scale as well. On a global scale, central banks are also printing money. They're also increasing the money supply throughout their global economies. And I do think that as they continue to do this, this is going to continue to provide support for global markets as well. I think another thing we should really look towards is global growth. How is global growth performing? How are global economies performing relative to the US? We talk about long-term trend growth in the US economy of around 2%. We're now seeing growth here in the US exceeding 6% on a quarter-over-quarter basis. And so growth is very, very strong in the US, but what is growth going to be like going forward? Well, our expectations here in the US that growth is still going to be run above trend. We're still going to be doing a really good job growing the economy, but things are going to start to decelerate a little bit from here. On the flip side, we think global growth, when we look internationally, particularly in emerging markets, as well as in the developed market economies, is actually going to start to outperform that here in the US. May not happen in the fourth quarter, but we do think as we move through the first quarter and second quarter of 2022, that growth begins to start to shift towards the international. And I think that as well can also be a really, really strong tailwind for stocks overseas, international stocks. And so that's how we're currently positioning the portfolio. Generally speaking, we're overweight stocks, but as we look to sort of balance between the US and international is growingly starting to look a lot more attractive to us.
Good to know.
Great. So our next question is actually from Vernon, and it kind of ties into that, is why is the financial stability of China so important to the US economy?
Well, because China is the second largest economy in the world. When you think about investing in emerging markets, China accounts for roughly about 40% of the emerging market complex. And so it's critically important, one, from a global economy, when we think about global GDP or global economic activity, China matters. China is very, very important. When we think about markets, investment markets, one of the reasons why, in part, emerging markets have lagged developed market performance has been because of the recent volatility that we've seen happen in Chinese markets. Now, we know that there are some instances where concerns about what China is doing, or the People's Bank of China, what they're doing over there with policy and how that might seep over into the US markets. We call that contagion. Is there some contagion risk of what's happening in China potentially bleeding over into US markets? And so China continues to be a very, very important piece to the global backdrop, the global narrative. Obviously, China has several billion people, and so from a demand perspective, if you see strong consumer demand from a large economy like China, that can tend to shift, demand, global supply chains. That can move stuff around from a global scale. And so, just given the size and how interconnected global supply chains are, China really, really matters for us as investors. And I think as the investment community becomes more and more, as we continue to bring more and more Chinese assets, if you look at MSCI, for an example, they're increasing the amount of shares that, or the percentage that China represents in its benchmark. And so us as global investors, China, and this is very similar both on the stock side as well as on the bond side as well. Global Barclays Ag, for example, which is sort of your global bond universe, that share, China's share of the global bond market continues to become larger and larger as well. And so for us as investors, looking at the global economy, China is critically important. And I think China and US relations is going to come back into the forefront, as we move into next year. I think once you move past some of the policy initiatives and fiscal negotiations, which will probably last through 2022. And then I think in 2023, we'll begin to start to look back again towards this China-US, this negotiation, and how this partnership will look, or this relationship will look going forward.
Okay, so our next question is actually from Gregory. And Gregory says, what is the outlook for the market in 2022?
So
that's a simple question.
Yeah, get out your magic ball.
I wish I had a crystal
I have
ball.
a wizard. Crystal ball. I have a wizard. If you did not know, Jordan, I have a wizard that I bring out on the radio station when we get questions like that. The wizard answers for us. So you can be our new wizard.
I will play the wizard for this one today. As I mentioned, we are generally constructive on markets. When we think about the S&P 500, we think that the S&P 500 can deliver a 5 to 10% total return for 2022, next year. Those are our expectations. Again, you're looking at a pretty strong return year this year. And so we think that, you won't get back-to-back years of potentially 20% gains, but we do think things sort of moderate as inflation cools off, as you start to see the Fed being less accommodative, right? They're talking about providing less monetary support to the system as we move through next year. Earnings are still expected to be very, very strong. But as we expect monetary policy to start to take a step back, fiscal policy as well, beginning to, we probably won't see another massive CARES initiative being brought to the market in sometime in 2022. But we still think, again, that markets can continue to grind higher, as Damon highlighted. Markets spend more time rising than they do falling. And unless we get a sort of canary in the coal mine, if you will, type of event that spooks markets, we do think that it's another positive year for stocks.
Good to know. We had a question from the floor here.
I was just curious, what factors do you think are going to make inflation cool off?
So Jordan, the question is, what factors do you believe are going to help inflation to cool off a little bit?
Well, the same factors that have been driving inflation meaningfully higher, we think are the same factors that are going to allow inflation to begin to cool off, to begin to disinflate. And so one of the few sectors of the economy that we're really seeing significant price pressures, if we were to use used autos, for an example, so there's been a significant shortage of semiconductor chips throughout those supply chains. And so you haven't seen as many cars come to market, new cars come to market. So there's been very strong demand for used cars. And as a result, that part of CPI had really accelerated very strongly over the earlier parts of the year. That's starting to come off. Of a boil. Obviously, more recently, energy, oil prices. You now have oil trading above $80 per barrel. That move higher. Oil started the year at around $50 per barrel. So that move higher has naturally led to higher energy prices, higher oil prices, which has pushed forward inflation. We do think that a lot of that has been driven by OPEC and the amount of production or supply of oil that they were bringing to the market. We think that at $80 a barrel, it's now profitable for a lot of these rigs to come back online and bring some supply back to the market. And so we think both OPEC and active shale producers here in the US are going to come back online. That should allow oil prices to begin to come down a bit. And so we also think when we look at just the general demand story in terms of the demand for services versus the demand for goods throughout the economy, as a result of the pandemic, we've all been buying stuff, right? I kind of feel like Bob the Builder in my new home. I'm buying wood to hang up new shelves and new picture frame, just a bunch of stuff and technology and goods and things. But we haven't been able to consume the services, going out to the movies, going out to restaurants the way that we've all wanted to. And as a result, you've seen a lot of goods inflation more recently, whereas services inflation has been relatively weak. Now, the key there is services inflation actually accounts for a larger share of the CPI basket. It accounts for a larger share of what we spend our money on an everyday basis. And so as you start to see that begin to normalize, I think that can allow CPI or inflation measures to begin to disinflate as well. With that being said, though, while we do expect inflation to cool from the 5% year over year pace that it's currently running at, we don't think that it's going to settle down at the pre-pandemic pace of 1.5% to 2%. We actually think that you're going to see inflation settle down at roughly around 2.5% over the course of this cycle. The reason being is because when we look at the labor market dynamics, there's a large labor supply shortage. There's a shortage of workers that's out there. Businesses are struggling to find that next worker. If we go to a restaurant where we're used to seeing maybe 5 waiters and waitresses, we're now seeing 2 to 3. You're seeing less folks at gas stations. You're seeing McDonald's paying $15, $16, $17 an hour with $1,000 signing bonuses. And so this is just an economy in which we have a shortage of workers, but demand for labor is so strong. And as a result, given the McDonald's example I just talked about, companies are raising wages that they're willing to pay in order to attract workers. And because they're raising wages, right? If you think about a company's sort of balance sheet and their cost structure, the three biggest costs to companies are interest costs, how much they pay to service their debt, input costs, so what they're paying for their raw goods and materials to come through the door, and wages. We're seeing pressure on the input cost side, right? Raw material prices have continued to move higher because of supply chain issues. And then wages, because there's a lack of available workers, our estimates suggest that there's roughly about 2.5 more available jobs than there are people looking for jobs in the economy right now. Companies are going to try to pay up for that next available worker, and that will create what we call higher wages. And higher wages, because they're paying more in wages to their employees, they're going to have to increase prices in order to maintain those margins, in order to maintain their profitability. And that tends to have a stickier impact on overall inflation dynamics. And so while we do think these sort of transitory, if you will, developments on inflation will begin to disinflate, there are some other trends underneath the hood that suggest that inflation will settle down at a higher rate than what we were at pre-pandemic.
Yeah, if McDonald's gets us used to paying $5 for a double quarter pounder, why would they lower it back to $3.50, right? So.
But now it seems like they may have to increase that to $6.50 because they're paying workers so much more, right? So,
well, in that case, I'm going straight filet of fish. I'm not worried about the double quarter pounder. Nobody eats the filet of fish that I know of. So
But this whole conversation reminds me of Canada. We have a lot of family in Canada, and we have learned from Canadians that they know more about our politics and about our country than most of us. They pay such close attention because they say that we, whatever is good for them has to be good for us. If it's not good for us, they know it's not going to be good for them. But they also always tell me like, oh, Victoria, we're Canadians. You know how on the magazines, it says your magazine is $8.95 and we pay $12.95. We just, whatever they tell us, we just pay it. We're just Canadians. And I feel like that's the way we are right now. It's like nobody's standing up going, okay, this has gotten a little out of control. It doesn't matter. It is what it is. And just like last year, we all learned what the word pivot meant real clearly. You needed to pivot. And we were very grateful for the DoorDashes and, all these delivery services that would come out, and how restaurants, bless their hearts, started having curb service. I'm surprised they didn't come out in roller skates, just like, here's your food. But, everybody has had to think differently just to stay in business. And like I just said earlier about the Lexus, the car dealerships, when you see there are no vehicles. I was down in Norman, there are no trucks at Ferguson. It's scary because we've never had that before. You're just used to driving up and having a plethora of choices. And now you've got 4 cars to choose from. It makes an impression in this part of the country when we see empty shelves, it does get people to a bit of that panic mode. What's going to happen? Where was it? You can't get a generator. Generators are just like, no, because everybody bought generators because everybody was so fearful of what was going to happen. And fear drives a market, fear drives behavior. And when we get that fear in us, it's kind of hard to shake.
That's
It
called,
really is.
called FOMO, fear of missing out.
Yes.
If you think all the bread's going to be gone, you're going to go and buy.
Let's don't even go down the toilet paper thing. They said it's
You'll
coming
go-
back.
You'll go buy 5 gallons of milk, even though the expiration date is 3 days away. And like, come on, everybody, we got to drink buckets of milk right now because that expiration date's coming.
Bank that milk
Yeah.
because we're not going to be able to have it. So, yeah. So that's,
But these are great points that you're making because, it really ties into the long-term trajectory. And I think these fears are unwarranted because it ties into the long-term growth prospects of the overall economy and by way of productivity. If you think about a company who's looking to expand, they're going to need workers to expand. And if they can't expand, if they can't find those workers to expand, that next opportunity, they may not invest, the same way back into their businesses. They may not look to make the employees that they have more efficient in the work and the hours that they're putting in. And so this does have a longer term impact in the overall growth narrative of the US. And so you make some great points.
Well, I do for us.
Okay, so are you ready for the next question?
Yep.
This is from Ron, okay? And he wants to know, do you have any end of year tax strategies for an almost retiree?
Ooh, that's a good one. I wouldn't call myself a tax specialist. I would almost defer to our friends at ChappelWood there.
Do you have anything?
no, you go ahead.
Okay.
I know you want to answer this.
Well, first of all, hey, Ron, it's good to see you online. I know he's online right now, so thanks for submitting this
Hey,
question.
Ron.
This is a good time of year to be thinking about your end of year tax strategies. The year is almost over, particularly if you've got some after-tax accounts. You get a 1099 for those accounts, and we do this kind of automatically, and or our strategists do, and I know JP Morgan does as well. It's called tax loss harvesting, and it's a lot easier to do if you're using individual stocks and bonds, but it's a good time to take a look at your portfolio and the taxable side of things to look to see, do you have any positions that are losing right now? Because chances are you've got a significant number of gains that you've had so far this year. If you've harvested some gains, you can harvest some losses. Generally, these are going to be stocks that you were going to get rid of anyway. You don't really want to hold on to them anymore. You can harvest those losses to offset gains. It sounds like, oh, go ahead.
Well, I was going to say, and we talk about this all the time on the radio show, in our quarterly reviews, that, people think about tax planning in April. They think about, some people start thinking about it at the end of the year. Tax planning actually is all year round. It's truly such an important part of every single thing that we do, whether it's setting up tax deferred accounts, Roth accounts and to minimize our taxes, to make sure, as Jordan brought up earlier about being well diversified. Well, that's also in where your money is, not just stocks, bonds, mutual funds, but everywhere your money is, so that when you do start drawing that in during those 30 years of voluntary unemployment, you minimize your taxes. And you don't start planning that when you get ready to retire. I know Terry will tell you that. Terry's here with us in the audience, and he started his tax planning about where's this money going to come from, and putting together strategies with working with Damon for years before he pulled the trigger, because he wanted to know that he was in the best position possible. When I see people that make bad tax decisions when they come to us after the fact, now most of the time we can't fix them or at least improve them. I always think of clients that came in and they're simply taking money from the wrong account. And it was like, why are you taking it from this account? Well, that's just what we thought we were supposed to do. Well, let's not do that anymore, because we could reduce your taxes by $11,000 a year. So taxes, even though, we talk about, yes, planning right now, tax harvesting, but it's really all year long looking at your taxes to see how can I best meet that tax obligation. Just like in January, every January, Shelley gets a report, and Shelley, for those of you that are guests, she is our director of client services, and she prepares a report that shows all of our clients what the required minimum distribution is. And the reason for that is it's really important, because you now know I've got to take this before the end of the year. So let's say you get the report, you've got to take that money, or let's say you don't get a report, you have no idea which you're really going to have to take because the government says so. Yet all of a sudden you have life happens and you want to take this wonderful family cruise and it's going to cost you $50,000. This happened. And you take that money, you call Shelley and say, I'm going to take the family on a cruise and I need $50,000. And she says, of course, and we distribute the money. And then all of a sudden December comes. And now we have taken money from the wrong account, because now you still have to take money from your qualified accounts. So now that is just messed up your plan dramatically, because it's caused you a tax problem. So what Shelley does is she has a report. So every time a client calls and says, I want to do X, Y, Z, under the regulations, she is to execute that request. But what do you think she does? Damon, Victoria, so-and-so wants to take money from this account. What we do is we look at it and see what's your best tax benefit for the year. If you still have to take RMDs, we say, well, that's a great idea. And of course you can take it from that account. However, Shelley, don't think of it. Take it out of this account and I will tell Bob, whoever, thinking about Bob, I will not say his last name, but Bob did this. And of course he was grateful for that. He said, oh, Victoria didn't even think about that. So when you make decisions, it's really all year long, making the right tax decisions.
Yeah, and I've actually got one other strategy, Ron, for you as an almost retiree. And this really goes for anybody. Our tax rates right now are lower than they will be starting in the year 2026.
Right.
They were lowered in 2018.
They sunset out into
Right.
2025.
Yeah, at the end of 2025.
That are current.
That's right. So 5
If
of the
they don't
7.
get changed.
Right. Well, we'll see. 5 of the 7 tax brackets went down. This is actually a really good time to consider a Roth conversion. And so if you're looking at end of year planning, if you have the capacity within your tax bracket to recognize a little bit more income without bumping yourself into the next tax bracket, it might be a good idea to look at converting some of your traditional before tax money to Roth tax-free or after-tax money. Why would you want to do something like this? Well, there are a few reasons. Number one, you're going to have to pay the tax on that money eventually anyway. So when would you rather pay it? Now, when you know the tax rates are going to be lower for you, or later when they will likely be higher. So that's
Yeah,
one.
I just have a question. When have taxes gone down? Just recently.
Just very recently.
I mean, they always and what have we not taxed? The
Right.
government's always looking at, like they got magnifying glass. Okay, what have we not taxed? And so when we do have these short periods where we do have, and we know they're lower than they typically have been, you take advantage of those things. And we have a lot of people that once the taxes went down, started looking at and converting a lot of taxable accounts to non-taxable
Yeah.
accounts. The caveat there, though, is this always kind of like deflates people a little bit when we say you cannot, because you've got to pay the taxes. So where's that money coming from? You have to have the funds to pay the taxes. And you would think common sense, well, Victoria, just take it out of my account, my conversion account. Government won't let you do that. So you do have to make sure that you have other funds in order to pay those taxes. And two, sometimes we split them up over several years.
Yeah,
a
it's
tax
called
conversion.
it's called a tax budget. You budget in how much additional tax
Can you
are you willing to
withstand?
pay?
Right.
And some other reasons why, because this later on in retirement, keep in mind when if you convert to Roth, later on when you pull that money out, it's tax-free. Well, that's going to have implications for your Social Security and Medicare, because the more taxable income you have, the more of your Social Security can be taxed. All right, that's that formula. The higher your adjusted gross income, the higher percentage of your Social Security that gets taxed. Distributions from Roth accounts are not included in that. Also, your Medicare premiums for Part B and Part D. The more income you have, the higher those premiums can go. Taxable income, adjusted gross income. Roth distributions do not count toward that. So there are multiple reasons why right now and for the next few years, assuming they don't change
Right.
the tax law,
Sure.
tax rates any sooner than that, it's a good time to consider possibly a Roth conversion. And Ron, we can talk more about that.
Yeah, and it does sound like it might be, it's just, I had this dear friend named Chucky, and not the same Chuck, it's not here, but Chucky, and Chuck would always say to me, I don't know, Diva, it just seems to me like the juice is just not worth the squeeze. Meaning it sounds kind of complicated. I know, don't you love that, Jordan? That was the best. I've always remembered, like, it was so brilliant, because it's like, oh yeah, and I agree with him. I like simplicity. However, in this case, it sounds more complicated. It's not, as long as you know what to do. And we work with your CPA and structure it for you. You don't have to make those hard decisions. We help you through that. So it sounded like when Damon was talking, it's, that whole squeeze and juice thing, but it's really not. And if you look at it in the long run, we also had an issue with a client that monies were not Roth. They were Roth money, and a trust attorney put them in and re-registered them when they did their trust incorrectly. Now, it cost a lot of money. That client too was, Victoria, I just don't know if the juice is worth the squeeze here. It took a long time. It was so much money that they couldn't not do it. It was so important to get that money converted back to Roth money, which it should have been. It took lawyers. It took letters to the IRS. It took money to do it. But in the long run, when we showed the client what it meant for her legacy, her children, she understood. And we'd say, you just go away. Victoria will just keep pushing this train up a hill.
We do have some other questions in the Q&A. Stacy, do you see those questions down there?
I sure do. Hold on, let me.
It looks like we've got 5 of them lined up. So
Yes, okay. The first question on here is from Lynn. And she says, what will be the impact if this legislation is passed where the government wants to know about every transaction over $600 from our checking accounts? Are they after our retirement 401k money?
Good question. Jan said, good question. Everybody's talking about that. And if you haven't gone in and sent a letter from your American Banking Association, they have a template out there that you can send in and allow the government to understand how you feel about that.
Jordan, do you have any thoughts on that?
I don't think that I don't think that makes its way into legislation. At that point, what's the point of FDIC and having insured and backing of your deposits at all these major banking institutions, right? And so I think, I think it's one of those sort of headline grabbers, if anything else. I don't think it's realistic.
If they can slip it in there, they will.
Well, I think they might want to focus more on cryptocurrency gains than trying to stick to have $600 balances in their cards, right? So, I do think, generally speaking, right, there is a focus, specifically amongst the IRS, to try to more accurately track transactions across the economy. Obviously, that threshold is now at $10,000, moving that down to $600. Again, I think logistically it could potentially be quite a nightmare. First, I think the burden that it puts on additional reporting and accounting practices and regulatory issues on global systemically important banks is quite cumbersome, and you'll probably get a lot of pushback from the GSIB banks in general. Again, I also think that, right, you've got sort of the safety nets in terms of FDIC insurance, as well as for those who are concerned about, potentially losing money or running the banks. So I think it's, I haven't really given it much focus because, again, I think it's much more of a headline grabber and very unlikely.
I am so happy to hear you say that, because clients have really reached out to us about that. We did get the American Bank Association template to send out, because, I mean, people are very concerned about that, Jordan, that we hear, and maybe y'all aren't hearing that same thing, but we are. So I'm happy to hear you say, and we're going to hold you to that, just so you know.
But again, I do think, right, in a lot of these policy measures that are being put out, one of the things is strong enforcement amongst the IRS. So bringing more accountants, more attorneys to the IRS. And I think a large piece of that focus is going to be more so on crypto markets, and trying to wrap their arms around a lot of the gains that's been experienced by crypto traders and the different platforms that are offering access to cryptocurrencies. And so I think there will be, from an IRS enforcement perspective, I think there's going to be more attention there than it would be in looking at every transaction over $600.
Yeah.
Okay.
We have another question from the
Okay,
audience.
yeah.
Since Jordan brought that up, one of my questions is, what is his thought on cryptocurrency? Should we be into it?
Did you hear that, Jordan? Should we be in cryptocurrency?
Should investors in retirement be in crypto?
Those who are if you are looking to for as a retirement account, a long-term retirement account, I don't think that that's where you should be putting your money if you're looking to save for retirement. From my perspective, I still believe today that cryptocurrencies is still a speculative investment. Now, if you are an investor, was there a question there?
No, I don't think so. We can hear you.
Okay, sorry about that. So again, I still think that is very much a speculative investment. And by speculative, I mean that you should be ready at any point to lose all of your money. And so now, with that said, if you are a long-term believer in the viability of cryptocurrencies and in a world in which fiat and cryptocurrencies can potentially exist and coincide together, or if you are a believer in sort of the underlying blockchain technology that supports the cryptocurrencies, I do think that there is some merit there, that there could be some long-term potential gains by investing in cryptocurrencies as a part of the portfolio. But today, right, you still see a bit of hesitancy from the business community to step into cryptocurrencies in a major way. Obviously, a few companies have begun accepting, but the broad institutional acceptance has been relatively low. I think this is sort of a very high level and big thinking type of concept. But if you consider cryptocurrencies in its purest form operating on a blockchain technology that essentially connects one buyer to a seller and not without any sort of intermediary, right? You almost sort of lose the need for a central bank.
Exactly.
You essentially revert back to, in its purest sense, a barter system using financial assets. And so at that point, there's no usability for a central bank to act as, or a commercial bank to act as an intermediary. And so you really would, the broad-based acceptance of a sort of cryptocurrency, well, which crypto you want to pick, which crypto would you use? Two, we're growing, we're learning a bit more about the mining of cryptocurrencies and the climate impact that it also has given its usage of coal and fossil fuel in order to mine Bitcoin. So it does suggest that there may be sort of a limit to just how much Bitcoin can actually be mined. There's a very interesting chart that shows the electricity usage that's required across mining all the Bitcoins that have been out there. And Bitcoin miners, right now, if you were to look at a chart of electricity consumption across countries, all countries across the world, Bitcoin is the 31st largest consumer of electricity mining Bitcoin. From a country perspective, it would be the 31st largest country consuming electricity as a result of mining Bitcoin. So there is a limit, right, to a certain degree of potentially how much Bitcoin can be mined. Now, again, with all this being said, we recognize that it's a very volatile asset class. I think we're trading at close to 66,000 a Bitcoin today. We could be at 40,000 tomorrow if China comes out and reinforces some of the regulatory bans that they put on. So if you're an investor who's willing to stomach the volatility of cryptos, then I think there's maybe a 5% sleeve in the portfolio, sure. But if this is for retirement assets, assets that were safer assets in the portfolio that were looking to last longer term to reach our goals, I certainly wouldn't have cryptocurrencies in the portfolio then.
Terry, Riverwind Casino is just down the road.
That was worth the $600 from the IRS.
Yeah. You'll have a lot more fun, and they might give you free drinks.
So what do you think?
Okay, so we have.
Hey, Stacy, we do have a question from our audience.
Oh, okay, sorry.
That's okay, thank you.
So I'm just sitting here and thinking, worldwide, and, what does he think about El Salvador adopting cryptocurrency as their national, what was it?
Their national currency?
Yeah.
So did you hear that question, Jordan? It was,
What other people call? Or
yeah. What do you think about El Salvador adopting cryptocurrency or Bitcoin as its national currency?
Well, it's been a disaster in El Salvador. Long story short, it hasn't played out very well throughout the broader economy. I mean, granted, within emerging
Do a market test, El Salvador.
Granted, within emerging markets, they generally tend to have less stable currencies as it stands, right? And so there's a need for sort of dollar reserves to be built up amongst emerging economies, because in the event that they do have a bit of a weakening in their local currency, they can go ahead and use dollars to purchase their currency to prop up that currency. So there's this natural sort of dynamic in terms of emerging markets having less stable currencies. And that might have been the driving force as to why El Salvador decided to make this shift into cryptos. Again, the challenge is it hasn't been proven. This hasn't been proven as a viable, consistent, and stable means of exchanging goods and services. I mean, you can even just look at sort of the NFT market or the non-fungible token market, where a piece of art or a baseball card is going for several millions of dollars, and it's like, where is this money coming from? How
I can tell you, I can tell you one of the biggest supporters and contributors. Do you know anything about Clubhouse, Jordan?
No, I do not.
Okay, well, Clubhouse it's audio only. It's been huge for the last 2 years. They launched it in March when everybody was at home. But you know who John Legere is?
Yes, I know that.
Okay, well, John Legere, he was T-Mobile's president. Big, I mean, they love this guy. He started the whole fuchsia black thing going on. He is huge into it. And I had to get on and listen because I'm like, what? And it's like, and all these celebrities are coming on. Denzel Washington comes on. Britney Spears has been on. Jessica Simpson's been on. They're all trying to figure out how to cut their hair to sell, that way to, I had this drink, I drank that water.
Yeah.
Unbelievable.
William Shatner actually sold.
Oh, yeah,
William Shatner sold copies, X-rays of his dental records when he was a boy. as an NFT online because somebody wanted to own Captain Kirk's teeth. Or
Yes.
something like that.
And it's like they always say though, just like art, it's like, who's willing to pay for that? And all you have to have is two billionaires wanting something that, nobody else can have. It's only two things. You only need two billionaires that want it, and the price is gonna go skyrocket.
Yep.
Because, it's like, okay, nobody else, that's all you have to have. But it is the most, to me, that alone is the most bizarre thing. Because this dental record, who cares unless you just need a conversation piece in your house?
Look, I'm a
You're
Star
gonna
Trek
frame it.
nerd, but I'm not that big.
Yeah, you're
Okay.
gonna frame it, put it in your house, like a piece of art, they do that so that, you have a conversation piece, but this is, kind of crazy of but people are spending so much money. And the reason I listen to all this, because it's our industry, I want to know when people ask us, I want to know that, okay, well, this is what it is, and this is what people are doing, and I'm listening to these celebrities. And we're talking, big celebrities on here about figuring out how they can benefit. I want to say John Legend was on there too once. It was Usher. Usher is so into this. He's going to figure out how to he's going to make so much money with this. And it's kind of fun being online and listening to him, and talking to him about this. Like, what? You're going to do what? But they are thinking of every single way that they can come up with something to sell. That was the most bizarre, is the dental records that I've heard of so far.
We're coming down to crunch time here. We've got more questions
But
than
this
we
has been
can,
really fun.
than we
Tori,
can
just so you
answer.
know.
There is one more question here that I have from our client, Julie, that I promised that I would ask. And it kind of ties into what you were mentioning a moment ago, Jordan, about the impact of mining Bitcoin, the use of electricity, that sort of thing. Her question was about ESG investing, environmental, social, and governance investing. More and more people are investing in this, and it's becoming more mainstream for businesses to have an ESG score. Her question is, what impact will ESG scoring of these big companies have on the market? Her concern was, are we going to see some of these big companies, because they have a higher carbon footprint and don't have a good score, are we going to see them locked out of the market and their stock prices suffer because of it?
I think that is a longer term type of trend that will happen. I don't think it's sort of a switch that'll happen next year or even the next 5 years. But I do think generally over the next 10 to 15 years, right, there's just going to be a natural, as we continue to invest in renewable energy, there's going to be a lesser dependence on fossil fuels and coal. I do think that there's going to be more of a focus on making sure that boards are well diversified across gender and across diversity. I do think there's going to be more and more of a focus on making sure that there's fair and equal pay across the different pay structures of these different companies. And I think at its core, ESG is a good thing, right? At a very basic level, it should be a good thing for a business, for a company. Having a diverse board has shown signs that you've got more diverse opinions, that you've got more seats at the table, and that you can service with higher quality, more clients. And I think, that's certainly a longer term trend. Where the challenges that we're seeing from an investment perspective is the lack of standardization of ESG scoring. You obviously have a certain sort of ranking profile across MSCI, which is now sort of considered the somewhat of the standard. But as asset managers, folks here at JP Morgan who are looking at stocks, we may have a different perspective on how we should rank governance or how we should rank environmental and climate initiatives. And so is it right? Is it something where, okay, let's look at, do all energy companies get a bad name, or should we look at the sector specifically and look at, okay, this energy Exxon relative to another energy company? Maybe that's how an asset manager may look at it. Maybe it's a sector story, maybe it's an industry story. So there's generally just a lack of standardization across the ESG ranking system. And I think a lot of asset managers have just, because of that, they've approached investing in ESG differently. You have your exclusion, where some asset managers will say, we just won't invest in anything coal related. We won't invest in tobacco. And I think in some regards that has shown to, over time, at least historically, hurt returns, because you are excluding general just opportunities. There are others who are more thematic, where they say we have you sort of, our internal ranking system, where those who would score a bit higher on the ESG rank have a larger weighting in the portfolio that relative to those who score a bit lower on our ESG rank. And so you still get exposure, but it's a tilted exposure towards the more ESG, quote unquote, efficient names. I generally think that this is a long-term trend. You're seeing, when I focus on institutional investors as well, big money from endowments are coming in towards ESG-focused type of funds, and the larger institutional community is starting to follow suit. And we're continuing to see more and more requests come in from institutional investors as well as our retail investors asking for what are your ESG catered type of products. It's not just going to have an impact on the stocks, it's going to have an impact on the bond market as well. And generally speaking, we call these quote unquote green bonds. These are bonds that are used to fund a school or education, or to fund a environmental friendly railway. And so that market continues to grow. And so money coming into sort of those municipal bond markets that are focused on ESG type of initiatives. Now, and I'll be very transparent with the folks who are on the call, where JP Morgan has sort of tried to make sense of all this is, do we want to be, and I think the broader asset management community is asking, do we want to be an asset manager that is exclusive of some of these ESG names, or ones that is more thematic, where we sort of rank these systems in our investment lineup? And I think we're sort of catered a little bit more towards that internal ranking system, where we still want to get exposure to a lot of these markets, recognizing that there's still big pieces of the US economy, but recognizing that over time, they'll gradually become more ESG friendly and efficient, and still providing opportunity to those investors who want access to those companies, less so on the exclusionary side, because again, you're excluding some of the opportunity set in the investment lineup. So I do think that ESG is going to stick around. ESG isn't going anywhere. We're seeing a lot of money, not just here in the US, but a particular focus in areas like Japan and Europe, where money continues to flow into ESG type of strategies. And so it really just depends on, as an investor, if you still want exposure to, energy, coal, tobacco, which I still think provide opportunities for investors, certainly, then you're going to want to, maybe ESG isn't where you're parking your money at now, but I do think down the road that you're probably going to start seeing more ESG thematic type of strategies that sort of overweight and underweight depending on the sector or industry that you're looking at.
Good. Well, ladies and gentlemen, let's give Jordan a hand for joining us today. Thank you so much.
In the hot seat, Jordan.
That's right. You answered some tough questions. We still have a few others. With your permission, Jordan, I probably will shoot some of these to you and see, and if you'd be willing to just type out an answer, we'll share it with all of our guests who are on today. We want to thank you for joining us, all of our clients, our wonderful clients. But this is not the end of your journey with us. There are other things that you can do with us. So let me make sure that I get here on this. All right. So how to take some action right now? Well, first of all, of course, you can always give us a call at that number, 405-348-0909. If you're outside of Oklahoma, you can call us at 888-838-DIVA. And you can request your Gold Bucket Optimizer. It's a no obligation appointment. We'll go through and show you where your money is and how we might better balance it for you. You can also register for our Wednesday lunchtime drive-through live webinar series. Very popular.
Very popular because Damon hosts it.
I host it, that's right.
Every Wednesday.
I mean, look how entertaining I am. Coming up, if you're here
And
local.
humble.
That's right. If you're local here in the Oklahoma City area, coming up on November 2nd and 9th, I've got my flagship educational program, Rock Your Retirement. I teach it at Francis Tuttle Technology Center in Northwest Oklahoma City. It's just $35. You pay that to the school. You have to actually enroll to the school. And right now, there are only 5 seats open. It's a 2-night course, and you get 4 hours of education. And we talk about income planning, taxes, healthcare, estate planning, and investments. You should also listen to our radio show. Subscribe to our podcast. You can go on iHeartRadio Saturday at 1 o'clock, Sunday at 6 a.m. Listen to It's All About the Money, Honey, the show that Victoria and I co-host. And then, of course, you can always subscribe to our YouTube channel and to our weekly e-newsletter. that comes out.
We're everywhere now.
And if you are,
He's not even bringing up LinkedIn,
Oh, yeah.
Facebook,
well,
Twitter, it goes on and on.
I do have one final poll question, and
Oh,
I'm
you
going to
do?
launch
Oh.
that poll question for you real quick.
Okay.
Right now. Oh, let me launch that. So the question is, would you like to be automatically registered for our next Diva and Friends event? I'm launching that right now. Typically, we host these in February, May, and October. We take off for the summer, but we'll get together another great guest for our February event. And if you would like to be automatically registered, let us know, or we'll send you the date and you can register yourself when we send out the link. As you guys are voting, one final thing, if you are curious, how do I get a hold of ChappelWood? There you see the lovely Shelley Myatt. She's sitting right over here. She's probably looking like, why did you put my picture up
up
on
there
the screen?
again.
But you can get a hold of her if you want to schedule an appointment, if you want to enroll in a class, enroll in one of our webinars. She's your point person, and you see our number there. We'll leave that number and email address up for right now. Eva, do you have any final remarks?
Well, I always have. First of all, I want to thank Jordan again for being with us today. It was very fun for us. And I know it was fun for our audience. So let's give it. Yeah. We want to say thank you. And as always, I say that we have the best clients on planet Earth. I'm not shy at all about saying that. I will say it till my last breath. But my best advice is always that y'all are so important to us, and that we're going to share with you and give you our best every single day. And my best advice as always is don't take advice from broke people, physically, financially, or spiritually.
Perfect. Well, we've got the results here. So those that
Let's
want to
look at
be,
them.
so we're going to end the poll here. So it looks like 72% of you want to be enrolled automatically. So we will make that happen in our next Diva and Friends event. And if you want to participate in any of our other educational,
I know it seemed like a
Opportunities.
lot that he just put up on that screen.
yeah.
So I always say the easy button at ChappelWood,
just
Shelley Myatt.
just call Shelley.
Shelley, call Shelley. 405-348. Call Shelley.
All right.
All right, and I want to say thank you to our live audience, and I want to say thank you to Pamela and to Shelley too for setting up a lovely table and have this. This was Damon. Thank you, Damon, because this was really a lot of fun to have a live audience.
Yeah,
So
yeah.
you want to be, yeah.
Well,
it was-
I certainly had a lot of fun, and I want to thank you all for taking your time out for having me on, and all of your clients to be on. They certainly are the best clients, because the questions that we got asked I certainly felt like I was on the hot seat. So thank you.
All
We
right.
did that intentionally there for you, Jordan. We don't want you to just be a slacker. So now we
That's
can
right.
all go out and brag about you. Well, next time, wait till I see Dr. Kelly in February. I'm going to be talking about you, Jordan. Get ready to blush. I'll ooh and ah.
All right. Well, Jordan, we want to thank you to Jordan. Thank you, Stacy, for being our moderator
Yes,
today.
thank you,
We
Stacy.
appreciate you. Thank you to our wonderful studio audience, our clients, and thank you to all of you. We work very hard to stay on top of things, to keep you educated, and we're going to continue to do that. So thank you so much. It's weird to say it, but happy
Yeah.
Thanksgiving.
It
Merry
is
Christmas.
weird.
Stay safe, whatever you do.
That's right. Stay
And
healthy.
as always, stay prosperous. We'll see you again soon. Bye-bye.
Bye. Thank you for joining us.